Welcome to vTalkInsight, Market Drivers Daily for May 15th, 2026. Oil is back near $110. Long bond yields are pushing to cycle highs, and the AI complex is finally showing two-way risk. That combination is forcing a rethink of how much pressure risk assets can absorb at once, and where the real stress points now sit across equities, credit, and currencies. Geopolitics has shifted back to the center of the macro story as energy choke points and U.S.-China frictions collide with already fragile markets. The core narrative today is a high but unstable oil risk premium, layered onto a tactical truce between Washington and Beijing that still leaves the most sensitive issues unresolved. On energy, the prolonged disruption around the Strait of Hormuz is keeping Brent above $109 and within sight of $110. Even as demand holds up. Reports of an Indian flag vessel attack near Oman, persistent threats to shipping, and expectations of a possible U.S.-led strike on Iran all underline how quickly this could flip from a slow burn shock to a fresh escalation. Iran's regime remains firmly entrenched and is using control over flows to maximize leverage, while markets continue to behave as if a reopening is only a matter of time. That gap between hard security realities and relatively contained pricing is an important source of event risk for the summer. At the same time, the longer-term story is one of gradual diversification away from Hormuz. The UAE plans to double export capacity through pipelines that bypass the strait. Saudi Arabia is routing more crude via the Red Sea. And U.S. policymakers are playing up domestic production and energy independence. If these trends continue, the strait's centrality to global flows should diminish over the next few years, even though the region will remain vital for overall supply. For now, that mix argues for elevated but not extreme oil prices as a base case, with the real tail risk sitting in a renewed military shock that pushes prices toward 120 and beyond. Against that backdrop, the U.S.-China relationship looks like a managed but still highly competitive freeze. The latest summit delivered frameworks for stability and a commitment not to pursue full economic decoupling, yet the tangible economic gains have been modest. The headline Boeing aircraft order landed around 200 jets, while below the numbers some had hoped for, and details on agricultural purchases remain hazy even as soybean and beef licenses are renewed. There was no movement on tariffs, technology export controls, or access to advanced chips, while China is accelerating domestic semiconductor efforts and keeping export curbs on critical minerals in place. That leaves global supply chains for chips, batteries, and autos still exposed to policy shocks, especially around Taiwan, where rhetoric has hardened and a multi-billion-dollar U.S. arms package is under review. In the near term, scheduled leader-level contacts into early autumn may keep outright confrontation in check, but the underlying rivalry in military and technology domains is deepening. For portfolios, this combination of persistent energy risk and unresolved U.S.-China frictions points to continued volatility in commodities, shipping, defense, and selected industrials, and a premium on understanding where supply chains are genuinely diversified rather than simply rebranded. Watch for any surprise moves on Hormuz shipping, new rare earth or chip restrictions, and the tone of messaging on Taiwan as key catalysts for risk premia from here, especially because markets have been leaning on AI-led growth to offset these geopolitical headwinds. Despite that backdrop, AI remains the engine engine of earnings growth and capital spending, but the tone has shifted from one-way optimism to a more balanced, two-way trade. Structural demand for compute and models is still extraordinary, even as valuations in parts of the complex begin to look stretched and more sensitive to rising yields. On the demand side, AI-related capital expenditure is running in the hundreds of billions of dollars this year and is projected to climb towards several trillion by the end of the decade, adding meaningfully to U.S. growth. OpenAI, for example, signals that enterprise clients already account for roughly 40% of revenue and could reach 50% by year-end, despite a record private funding round that may still fall short of future compute needs. Chip demand reflects this intensity, with AI-related shipments growing at around 20% quarter-on-quarter in orders in some segments outstripping effective supply by as much as 10 to 1. That imbalance is supporting strong earnings and backlog visibility across semiconductors, data centers, and related infrastructure. Capital markets are responding in kind. Cerebra's recent listing, with a multi-billion-dollar deal size and a near 70% first-day gain, underlines how keen investors are to own pure-play AI hardware, even when margins are thinner than at traditional chip makers. Private valuations are racing ahead too, with names like Anthropic reportedly approaching levels once reserved for the largest listed technology companies. At the same time, adoption is broadening beyond big tech and enterprise software. Code assistance platforms have doubled weekly active users in a month in markets, such as the UK and Germany, and specialized applications from sports analytics to design tools are posting strong revenue upgrades as they embed AI features. Market price action, however, has become more volatile. Flagship stocks, such as Nvidia, have delivered weeks with gains near 20%, followed by sharp pullbacks as the broader equity market reacts to rising bond yields and geopolitical headlines. And the recent global bond sell-off has halted parts of the AI-led rally. Even so, large AI platform and chip names generally carry low net leverage, and much of the infrastructure build-out is funded from cash flow, making them less immediately exposed to higher borrowing costs than many traditional cyclicals. The key debate is how far this can run before valuations and capacity catch up. Some valuation metrics for AI hardware and infrastructure businesses now exceed those seen during the early 2000s, and the combination of parabolic IPO pops, rapid private revaluations, and uncertainty about when infrastructure build-out will reach equilibrium is fueling bubble concerns. Policy and supply risks are another constraint. Export controls are pushing Chinese AI players toward domestic chips, threatening demand for some U.S. suppliers, while advanced chip shortages and rising inference costs are already forcing enterprises to prioritize scarce capacity. From here, the focus is likely to be on AI earnings guidance, pricing discipline in upcoming IPOs, and whether adoption spreads from large caps into the broader corporate base in ways that could eventually reduce earnings volatility and help justify higher sustainable multiples, all against the backdrop of a rising global cost of capital. All of these stories are playing out against a rates backdrop that is itself undergoing a regime shift. Long-end government bond yields in the U.S., UK, and Japan are moving into territory not seen for decades, tightening financial conditions and increasingly dictating the terms for every other asset class. In the U.S., 10-year Treasury yields are hovering in the mid-4% range, with market participants fixated on the prospect of a move toward 5% that many see as a trigger for broader equity stress. 30-year yields are around 5.1%, levels described as problematic for multiple asset classes if sustained, while 2-year yields sit above 4% and even above the effective policy rate, signaling expectations of another hike by around next April. Japan's 30-year government bond yield has climbed above 4% and recently touched about 4.44%, its highest since issuance in the late 1990s, and UK long-dated gilts are at their highest yield since 1998. The drivers of this move are familiar but now overlapping. Recent consumer and producer price data have surprised to the upside, and energy is a key channel. Brent trading above $109, combined with higher freight and packaging costs, is feeding expectations for stickier inflation through food and consumer goods. Political dynamics add another layer. In the UK, leadership uncertainty, contentious debates over immigration, and concerns about future fiscal expansion are pushing gilt yields higher and weighing on sterling, with 10-year UK yields now above those of Italy and Germany. Globally, greater defense spending needs and already elevated deficits are increasing bond supply, and markets are increasingly seen as disciplining governments by demanding higher compensation at the long end. The impact on risk assets is becoming more visible. Equity futures across the U.S., Europe, and Asia are under pressure, with the S&P 500 and Nasdaq giving back recent highs and Korea's Kospi down more than 6% in a single session. European benchmarks, such as the Stoxx 600, the FTSE 100, and the DAX, are all trading lower, led by rate-sensitive sectors. Property names and UK banks are under notable strain as funding costs rise, while European technology and basic resources stocks are also underperforming as higher discount rates collide with concerns about Chinese demand. One notable change from earlier cycles is that treasuries are no longer acting as a straightforward safe haven, with yields rising even on days of heightened geopolitical tension and more defensive flows tilting toward the dollar instead. The shape of the yield curve has itself become a market narrative. With front-end yields elevated by expectations of higher for longer policy and the long end unanchoring on inflation and fiscal worries, investors are debating whether this marks a durable, steepening regime. Some see 10-year yields in the 4.6 to 4.75% range as a danger zone for equities, with a sustained move above 5% likely to force a broader rating, especially for companies without strong earnings growth or clear AI exposure. At the same time, there is skepticism about extending duration at current levels. In the UK, for instance, many investors prefer intermediate maturities, viewing long-dated gilts as unattractive unless yields move closer to 6.5%. Counter-arguments emphasize that, so far, moves in rates and currencies remain relatively orderly, and that much of the repricing reflects still solid growth and the strength of AI-linked sectors rather than an outright loss of control. The 30-year U.S. yield has struggled to hold well above 5%, suggesting the market may already be probing what the new equilibrium looks like rather than pricing an inflation spiral. Looking ahead, the key signposts will be incoming inflation releases, any shift in guidance from the incoming Fed chair, the interaction between oil prices and 10-year yields as they edge toward the widely watched 5% threshold, and how credit spreads and duration-sensitive sectors like real estate and UK financials trade into that environment. Together with the geopolitical and AI dynamics we discussed earlier, these yield levels will go a long way toward defining the risk profile for multi-asset portfolios into the second half of the year. To sum up, geopolitics is keeping a persistent risk premium in oil and critical supply chains. AI remains the dominant but more volatile growth engine, and long-end yields are repricing higher in a way that is now clearly biting into equity and credit valuations. Watching how those three forces interact around key thresholds, such as Brent near $110 and U.S. 10-year yields approaching 5%, will be crucial for understanding the next phase of market volatility. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.